Dividend investing can be a great investment strategy. Dividend stocks have historically outperformed the S&P 500 with less volatility. That's because dividend stocks provide two sources of return: regular income from dividend payments and capital appreciation of the stock price. This total return can add up over time. Because of their lower volatility, dividend stocks often appeal to investors looking for lower risk investments, especially those in or nearing retirement. But dividend stocks can still be risky if you don't know what to avoid. Here's a closer look at how to invest in dividend stocks. Hello guys, and welcome to Passive Investing, where we build your financial knowledge right from ground zero. Today we'll tell you about dividend stocks, how they work, and what are the best ways to gain from investing in dividend stocks. Make sure to subscribe to the channel and do hit the thumbs up if you gained anything from this video. How dividend stocks work. Let's look at an example. Say you buy 100 shares of a company for $10 each, and each share pays you a dividend of 30 cents annually. If you invest $1,000 over the course of a year, you would receive $30 in dividend payments. That works out to a 3% yield. Not too shabby. What you choose to do with your dividends is up to you. You can reinvest them to buy more shares of the company, buy stock in a different company, save the cash, or spend the money. Regardless of whether the company's stock price goes up or down, you would receive those dividend payments as long as the company continues to disperse them. Dividend stocks can maintain a dividend payout in every economic environment, which the COVID-19 pandemic has demonstrated. But a diversified portfolio of dividend stocks can produce reliable income rain or shine. Combine those dividends with capital appreciation, and the companies you own grow in value, and the total returns can rival and even exceed those of the broader market. Before you buy any dividend stocks, it's important to know how to evaluate them. These metrics can help you understand how much in dividends to expect, how reliable a dividend might be, and most importantly, how to identify red flags. Dividend yield. This is the annualized dividend represented as a percentage of the stock price. For instance, if a company pays $1 in annualized dividends and the stock costs $20 per share, then the dividend yield would be 5%. Yield is useful as a valuation metric when you compare a stock's current yield to its historical levels. A higher dividend yield is better, all other things being equal, but a company's ability to maintain the dividend payout and ideally increase it matters even more. However, an abnormally high dividend yield could be a red flag. Dividend payout ratio. This is the dividend as a percentage of a company's earnings. If a company earns $1 per share in net income and pays a 50 cents per share dividend, then the payment ratio is 50%. In general terms, the lower the payout ratio, the more sustainable a dividend should be. Earnings per share, EPS. The EPS metric normalizes a company's earnings to the per share value. The best dividend stocks are companies that have shown the ability to regularly increase earnings per share over time, and thus raise their dividend. A history of earnings growth is often evidence of durable competitive advantages. P/E ratio. The price-to-earnings ratio is calculated by dividing a company's share price by its earnings per share. The P/E ratio is a metric that can be used along with dividend yield to determine if a dividend stock is fairly valued. There's a misconception that dividend stocks are only for retirees or risk-averse investors. That's not the case. You should consider buying dividend-paying stocks whenever you start investing to reap their long-term benefits. Dividend stocks, especially those in companies that consistently increase their dividends, have historically outperformed the market with less volatility. Because of that, dividend stocks are a great fit for any portfolio, as they can help you build a diversified portfolio. There are a few dividend strategies to consider. The first is to build a dividend portfolio as part of your overall portfolio. When you're building a dividend portfolio, it's important to remember that paying dividends isn't obligatory for a company, in the same way that companies must make interest payments on bonds. That means that if a company has to cut expenses, the dividend could be at risk. You cannot completely eliminate the risk of a dividend cut, but you can lower the risk. Focus less on a company's dividend yield and more on its ability to consistently increase its dividend. Look for a company with a sound financial profile focused on a growing industry. Another aspect of a dividend investing strategy is to determine how you want to reinvest your dividends. Some investors opt to reinvest their dividends manually, while others use a dividend reinvesting plan, also called the DRIP. This powerful tool will take every dividend you earn and reinvest it, without fees or commissions, back into shares of the company. This simple set-it-and-forget-it tool is one of the easiest ways to put the power of time and compounding value to work in your favor. Another dividend investing strategy is to invest in a dividend-focused exchange-traded fund or ETF or mutual fund. These fund options enable investors to own diversified portfolios of dividend stocks that generate passive income. No matter what dividend strategy you use, adding dividend stocks to your portfolio can be beneficial. They can help reduce volatility and boost your total returns so that you can reach your financial goals a little faster. That's all from us today, folks. Make sure to subscribe to the channel for more knowledge of the financial world. We'll see you next time.